Welcome back, everyone. We have another tier ranking video. These are always fun to do. And in this case, I'll be ranking the free cash flow profile, the free cash flow of 24 of the most popular stocks in the market. And here's the kicker. These are stocks that I don't own, not a single one of them. So they are 24 popular companies that I do not own. We have stocks like Meta, FICO, Elf, Grab, Shopify, Spotify, Hims, Robinhood, Cheesecake Factory, Warner Brothers Discovery. We have CrowdStrike, Duolingo, Disney, Reddit, Nvidia, on and on. So I'll be ranking these companies based on which ones are generating the most wealth for shareholders, which ones are growing that free cash flow undiluted the fastest and the most predictable. Now let's go ahead and jump in. Okay, so we're starting off with a big one here. We have Meta. Let's take a look at this one. I've looked at Meta. This is one that I've been tracking, and obviously the share price shows this company's been on a roll. But we have to look at the free cash flow. What I like to do personally, looking at free cash flows of companies, is quarter by quarter, free cash flow is pretty volatile. You don't get the best picture. It looks a little messy. So I like using the quarterly trailing 12 months. That just means the most previous 4 quarters combined, every single quarter, it's showing the trailing 1 year. So this is what it looks like with Meta. Overall, very, very strong. You have these valleys and peaks, but underneath that, you see consistent free cash flow growth. Now, there is a couple things. It doesn't look perfect. We have a big low in 2022. We have it resurgence back upwards. Now it's starting to go back down a little bit. If we look at this on a per share basis, we can see that it looks a bit better, meaning that Meta is doing buybacks, so it's actually increasing faster. One of the issues I think with Meta, along with a lot of big tech companies, is when we factor in the stock-based comp, we do have a lot of dilution here. So even though they're generating $52 billion in free cash flow over the trailing 12 months, they have $17 billion of stock-based comp. You have an impact of somewhere around 33%. I'd be happy to own a company that has a free cash flow profile that looks like this. Meta's going in the A category. It's not there yet in the elite category of S. It's not perfect. There's just a bit too much stock-based comp. Other than that, pretty good. Next up, we have Hims, the subscription drug company. This company's sure growing fast. Look at the revenue of it. Sheesh, it is growing really, really fast. Total subscribers are going up like crazy. We have the monthly revenue per average subscriber. That's also going up like crazy now, $84 per sub. But we get to the free cash flow. How does all of this translate to profits? Well, I'll give the caveat that Hims still feels like it's early in its journey, so I'm not expecting much. But looking at this, it looks pretty good at first glance. It's going up like crazy. Plus 346% year over year, rapid free cash flow growth. I like seeing that. Now, we have to dig in a little bit deeper. When I look at the free cash flow per share, let's see how dilutive they are. You see the change there? We go from free cash flow, and this is like that Homer Simpson meme where he has the clip pulling all of his fat behind him, all of his skin tight. It's what you're seeing right here. You're seeing that meme play out where we go from the free cash flow. It looks really pretty at first glance. This is what management would love you to focus on. When you factor in dilution and you divide it by the amount of shares outstanding, because Hims is diluting, we can look at that right here. They have to have shares going up. I don't even have to look at it, but you can see the shares going up. 210 million, 221, 229, 234, 235, 240, 246. If you're a shareholder, you own a percentage of a company. As they print more shares, your percentage gets smaller. You're entitled to a smaller portion of the cash flows. So it directly affects how much cash you are entitled to as a shareholder. So we don't like seeing this part of it. When we put these side by side, this is the dilution that's happening. Roughly half their free cash flow is eaten up by stock-based comp. Now, again, this is a company early in its journey, so I don't consider that too much of a problem right now. Looking at the free cash flow profile today, it looks like it belongs in a C. It's not terrible, but it's also not amazing because they have so much dilution going on. Now, it's trending in the right direction in a year, so I could see it moving up to a B or an A. That's what we like to see. Next up, we have Shopify. This is the best company out of Canada. Some people will argue that it's Brookfield. I don't agree. I think Shopify is a better company. It is a genuinely amazing tech company, a finance company. They're building out a huge digital ecosystem. I think it's great. So this one is one that I really like. I've looked at it. I hope to own it someday. When we look at the free cash flow profile, let's bring it up here. First glance, it looks like it's growing rapidly. We're looking at operating leverage. You don't have companies grow free cash flow this fast without a lot of operating leverage. It went from essentially nothing in 2022, now generating 1.73 billion. So massive parabolic growth. When we look at this, the free cash flow per share also doesn't look too much worse. Notice the subtle change there? It goes from a 64% growth rate to a 63. Right now, Shopify is in the B tier category. Well on its way, doing great, but it's not quite up there with the A or S tier companies that are in the elite category. Next up, we have FICO. I bet you can guess where this one's gonna go. Come on, it's gonna go in the S tier. FICO is an S tier free cash flow generative company. And the way to think of that is try to find a company that has a better free cash flow profile than FICO. It's insanely difficult. They almost don't exist. There's not many companies on planet Earth that have generated more free cash flow at a faster clip and a more consistent basis. When we look at this over time, back from 2002 to 2015, FICO would be somewhere in like a C tier. It's not really growing, it's just kind of maintaining. And they were growing volume of scores over that time period. In 2017, they started to change their pricing structure once they got to saturation, and they flexed incredible pricing power. Now, there's so much pricing power inherent in this company that the government's looking at it. That's when you know a company's very, very powerful, when the only entities that can really prevent it from raising prices is the government. Now, the free cash flow has grown 48% over the past 1 year. In the past 5 years, it's grown 21%. Not only that, but it's so efficient, they've done so many buybacks along the way, that it's grown at 49% on a free cash flow per share basis. So this one goes in the S tier. It doesn't have anything else to prove. Next up, we have the beauty company, e.l.f. Beauty. This is the makeup company. Let's go ahead and take a look at this one here. We can bring it up on Qualtrim. If you're not aware, e.l.f. Beauty is one of these companies that came in and they disrupted the makeup market, the beauty market, with lower price goods. And they somehow convinced girls it's okay to buy lower price goods. They're just high quality, but they're at a better price point. You don't have to break the bank to buy some makeup. And so it's a great product overall. I really like what they're doing. When we look at the revenue growth, they certainly had a ton of revenue growth since 2021, going from 400 million up to 1.3 billion. But with a lot of these companies, they are so susceptible to different economic changes that their margins go up and down. And this is what we see over time. Now, this isn't the prettiest free cash flow history that I've seen. We're currently sitting at the same free cash flow it generated over the trailing 12 months that it did way back in 2016. I don't like seeing that. I'd rather have a company reach new highs in free cash flow and never go back down. That's what Berkshire does. It's never going to go back down. FICO's never going to have free cash flows today of what it had in 2016. It'll just never happen. Same thing with Netflix and many other companies. The other thing that we can look at here is if we zoom in a bit to the past 5 years, we go to the free cash flow per share, it also doesn't look quite as compelling because the company is doing a substantial amount of dilution. So to fund their operations, to get through whatever time periods they're going through, you can see the share count going up like crazy. Right now, I put e.l.f. in the D tier category. Now, keep in mind, this is just on their current free cash flow profile. It can improve over time. There's other aspects of a company, but the free cash flow is a bit too volatile for this one to be included with these other companies. Next up, we have Disney. I used to own Disney at one point. It was actually a company that I lost money on, unfortunately. A small amount, but I did lose some money on it. And we're going to take a look at Disney's free cash flow here. The biggest thing that investors need to appreciate about Disney is the magnitude of the transformation and the complexity of the business. This business is far more complex. The transition they're going through is far bigger than most people anticipate. They have ESPN, they have parks, they have cruise lines, they have streaming services, they have disparate media conglomerates and different things that they own. Disney's so big, so complex, that it's very difficult to do analysis on. Now, when we bring up the free cash flow of this company over time, it reminds me a little bit of e.l.f.'s in terms of having a lot of history, a lot of volatility, long periods of no growth. Overall, what I don't like in this free cash flow line is the fact that we're back to where we were back in 2014. So we have essentially a full decade of flat free cash flow. Now, if we just go to the past couple of years, it looks great. It looks like they're growing it. But again, if you're an investor since 2015, which many people are, you've seen no growth in this company over the past decade. And stock prices follow free cash flow. So when we bring up the stock price over the past 10 years, you have 3% returns. Not per year. This is just your return, 3%. Not good. So what we see here is a stock that's just trying to reclaim the same free cash flows it had during its peak era, 2015. I'm putting Disney in the E tier. I think it deserves to be there until it can grow a stable line of free cash flow for more than a couple years. Right now, it just hasn't proven that. This company's already lost a lot of trust with investors. Next up, we have Duolingo. This is the app you can learn different languages. It's a subscription and ad tier model. They also have added in a lot of different things, like you can learn math or chess. There's all these different verticals they're going down. The revenue is growing very quickly. We see lots of metrics like EBITDA moving up. So how does this translate into the free cash flow line? When I look at it, it looks honestly pretty good. There's not much to complain with here. It looks good across the board. 52% year over year based on the trailing 12 months. They've never had a quarter with negative free cash flow. Let's go ahead and take a look at their stock-based comp. Their stock-based comp is big, but it's mostly fixed. It's not going up that much. So the free cash flow is growing dramatically faster than the stock-based comp. We see the free cash flow per share looks pretty good, growing 41% year over year. This company has done nothing throughout its history except grow its real free cash flow per share over time. Duolingo for me is going to go in the B tier category. It is getting close to that A tier category. It just needs more time to prove itself. Next, we have Carvana, notable for their vending machines of cars. You've seen these huge buildings on the side of the road. It's a company where they make it real easy to buy or sell your cars. That's the whole pitch. And I'm frankly surprised that this company's still in business. For a time period there, I thought they were going out of business. Let's take a look at how things have evolved. The revenue went down. Well, it spiked in 2021. Then it started to trend downwards. Then in 2024, it started to pick back up. So things started to head in the right direction. Now, this company was extremely cash flow negative at one point, losing up to $3 billion a year. On a trailing basis, they're losing over $3 billion per year, but they turned it around. Losses went from $3 billion to $2.5, down to $1 billion, down to minus $500 million. Then they started to actually have positive free cash flow. Now, it's not like they're generating crazy amounts of money. In fact, it's going to take a long time based on this to grow to where they make up for their losses. But they are now actually a free cash flow positive company. Good job for them, at least not going bankrupt. I think that needs to be applauded. That's a pretty remarkable thing to do given the circumstances. But I'm going to put this one in the F tier category for now. It just doesn't look pretty. Next up, we have Uber. We all love Uber. Let's go ahead and take a look at this one. Uber's growing real fast. We have Bill Ackman in on the stock, buying it big. And every metric, you just look at these charts. They're all moving up and to the right, exactly what we want to see. They have active users growing, revenue, gross bookings, the amount of trips done, EBITDA, and this is all translated into a much stronger than previously thought company. For a while, Uber had the same thing where it was losing a lot of money. It looked like things were going bad. They started to move things in the right direction. They reached scale. A lot of the centralized expenses of running a robotaxi network, like having the support staff, the infrastructure, all the people to help out with everything, those scale really well with the amount of rides done. So you see that operating leverage kick in, and then they turn positive in 2022. Now it's growing consistently. What I see here is basically a line of free cash flow growth all the way back from Q1 of 2020. Just a big line from negative to positive. I'm going to put Uber with Meta. It's not perfect, but it's really good. Right now, I think it's A tier. Next up, we have Robinhood. This one's become more popular as this company's pushing out a lot of new products, a lot of new features. They're doing some cool things. Now, granted, free cash flow is not always the best metric to use for anything that resembles a bank. So I understand it's not the best metric here. And this is what we see with some banks or different financial institutions when measuring free cash flow. It doesn't look that consistent, but in terms of free cash flow, they're not really generating anything above their stock-based comp. Now, again, this is a free cash flow ranking, and I have to rank it primarily by the free cash flow. I understand there's good things going on with Robinhood. It's not a bad company. I'm not saying that, but right now, the free cash flows don't look amazing. Next up, we have Warner Brothers Discovery. This company's gone through a bit of a journey. It is the HBO Max or the HBO Max streaming service. They keep changing the name of it. Let's go ahead and take a look at the free cash flows. Now, when we look at the free cash flow, let's bring it up here. Where is it? There it is. We have the free cash flow chart. it looks pretty good. We have the free cash flow going up dramatically in 2022. It went up to $7 billion, but it started to come back down. In fact, it's actually come back down by half. So the free cash flow looks okay. We had a big spike there. The real problem with this company that you'll see is this is the tricky part. This is why we have these additional tabs here that you can click on. You want to look at the free cash flow per share because remember, you're buying shares of a company. Dilution matters. When we click on this, the picture changes. We can just look at that again. You see the difference these two different metrics make? We're visually illustrating here. One of them, it looks pretty good, like it's going up over time. The other paints an entirely different picture. Now, why is that the case? Because they diluted shareholders a lot to fund a big acquisition. It's not just Warner Brothers, it's Warner Brothers Discovery. To buy Discovery, they had to dilute shareholders a sizable amount. When we look at this metric, which I think is more telling for the real situation that shareholders are in, it really does look terrible. Right now, this is not a great performing company with its free cash flow. And on a side note, the investors were correct to deny David Zaslav, the CEO of the company, a $51.9 million pay package. Now, this almost never happens because in most cases, people are pretty happy with their CEOs. They're usually generating wealth, doing their thing. But investors roundly denied it. They said they don't want to pay them, and I don't think they should. As an investor, you want returns. That's why you're paying the CEO to operate the company, to execute, and at the end of the day, to get positive returns. When we look at this company, it's down 71% over the past decade. Over just the past 5 years, it's down 62%. Why would you want to pay the CEO $50, $60 million when you're getting crushed in the stock? It makes no sense. So I agree with the shareholders. I would have voted to not pay him as well. Now let's go ahead and move this to the F where it belongs. Next up, we have Spotify. This is another company, another stock I really like qualitatively. I like the product. I like how users are addicted to it. I love how ubiquitous it is. I love how big the total addressable market is. It reminds me in a lot of ways of Netflix. Now, I've hitched my ride to Netflix firmly. I actually think that Netflix is a bit better than Spotify for a couple different reasons, but Spotify is not bad, and the stock is doing fantastic. You see revenues growing, their monthly active users growing over time. We have some cool charts here showing that the premium users, ad-supported users are both growing. And how is this translating into free cash flow? Well, similarly to Netflix, the company has had explosive operating leverage and free cash flow growth over just the past 2 years. So in 2023, it was $58 million of free cash flow. The trailing 12 months, it's $3 billion. Huge growth for this company, really tremendous growth. When we look at it on a per share basis, it looks about the same. Again, 200% free cash flow per share growth. Obviously, the stock is going to move up. When we look at the stock-based comp, it's actually going down as they're growing free cash flow. I'm putting it in the A tier category. Very good, a very good start, but they need a few more years to really justify being in the S tier category. Now, next we have MSCI. If you're not familiar with this company, it's the one where they have the indices for companies outside of the US, so global indices. It's kind of like the S&P Global or the, S&P Index, but for foreign companies. And it has a lot of growth because foreign markets have lots of organic growth. So what we see here is a company that's growing organically over time for long periods of time. We have a company that has high retention rate. They earn a lot of money through fees by people linking to their ETFs, basically the same way that the Dow Jones indices or S&P Global earns money with their indice business. And you see the retention rate remain very high, 95.3%. People can't move away from these ETFs. We look at how this translates into the free cash flow profile. Now, this people, ladies and gentlemen, this is what an S-tier free cash flow profile looks like. It goes up and to the right consistently, almost every single quarter after quarter, organically for years. They prove this through years of time. We go over time, and it's a bit rocky back in like 2012 to 2013, but still not even bad. Ever since then, for well over a decade, they have had a straight line. I mean, just look at it. Visually, you can see. It's very easy to determine which companies are fundamentally strong based on their free cash flow profiles. Now, of course, we can look at the big caveat. Are they diluting shareholders like crazy? Let's look at the free cash flow per share. They're not only not diluting shareholders, But they're such an efficient business, they funneled this back into share buybacks, which means that the free cash flow on a per share basis is growing even faster. Take a look at that. It looks like a steeper line when you have a free cash flow per share. This one is going in the S tier category. I just think it belongs there. Next up, we have Cheesecake Factory. Now, some investors kind of scoff at food companies, restaurants, especially sit-down restaurants. I don't. I've made a lot of money with restaurants. Every investment that I've made into a restaurant, like Starbucks, Chipotle, Texas Roadhouse, they've all made money. Chipotle was a fantastic investment. It went up around 30% in just a few months. Texas Roadhouse is literally one of my best investments of all time. Substantial gains in that company. So I take restaurants rather seriously. I've looked at Cheesecake Factory a time or two. My biggest apprehension for this company is that their restaurants are very ornate and kind of elaborate. They're not really easy to just open up anywhere. They also have a very complex menu. And most restaurants find it difficult to scale with as big or robust of a menu as Cheesecake Factory. So they basically have a more elaborate operation that inhibits their ability to rapidly scale, like a Texas Roadhouse, like a Starbucks, like a Chipotle. But either way, I think there's a lot of positives to it. I really like Cheesecake Factory. I think it's a fun place to go. I always look forward to it. When we look at the free cash flow on this restaurant, it doesn't look great right now. It's basically generating free cash flow consistently, which is good, but it's not growing it. And while it's true, not every company needs to grow free cash flow. You can run a big profitable business and have the same free cash flow every year. As an investor, you want growth. To beat the market, you want growth in these metrics. I'm going to put this one in the C tier category. It's not terrible, but it's also not amazing. Right now, they still have some work to do to really grow that free cash flow per share over time. Next up, we have Airbnb, the company that's trying to become the everything app. They are basically a direct competitor to a company that I own, which is Booking Holdings. Now, when I initially looked at Airbnb, that's what actually led me to Booking Holdings. It shows up when you're doing research on the company. And then I saw more research, more from my Discord, different members, and I started to like Booking Holdings more than Airbnb. The stock has outperformed Airbnb almost over every time period. We have the free cash flow line here, which is all right. It's really not amazing. When we look at this, it really hasn't moved much over the past year. When we look at the free cash flow per share, it's up 5% over the past year. I'm going to put this one down in the D category. I think it has a lot to prove. It really has to keep up with its competitors and even try to grow faster. Next up, we have ServiceNow. This is a company that I've looked at similar to Salesforce. From my research, ServiceNow is actually a better company than Salesforce. It has more organic growth, a little bit more operating leverage, higher margins, a faster top-line growth rate, but it is far, far more expensive. Salesforce trades at a substantial discount to ServiceNow. We look at any of the metrics, they're all moving up and to the right, and the free cash flow is no different. It looks really, really good. We're looking at a company growing at 16% in the past 1 year, 30% over the past 2 years in a CAGR. The only thing that I'd take away is that they do a lot of stock-based comp. Now, they're growing their free cash flow faster than the stock-based comp, so that per share growth is still strong, but this is a lot of expense. It's a big drag on what they could otherwise return back to the shareholder. I'm putting it in the B tier category. It's very strong, consistent for a long period of time, but that huge amount of stock-based comp, over 50% of the cash flows being eaten up by that, bumps it down from the A tier category. Next up, we have Nvidia. Let's go ahead and take a look at this one. You might be able to guess where this one goes. It looks kind of like this is the type of company that you wouldn't even be able to make it up. I mean, it would seem silly if you just guess that it would grow the way that it has. You would seem like a lunatic, like a heretic, prophesying of some great company that would grow free cash flow the way that it has. Look at this history. It's hard to actually illustrate how fast the free cash flow has grown. So no matter what way you look at it, this is S tier free cash flows. Nvidia is a very easy one to rank. Next up, we have the social media company Reddit. This is one of the newer social media companies to the market, even though Reddit's been around for a long, long time period. Now, they've implemented a lot of things that are kind of one-time things like licensing data and that type of thing to grow their revenue rapidly over just the past year. So we see some rapid growth here. And I do like the direction this is going. Free cash flow positive, rapid growth year over year on a very good trajectory. When we switch this to free cash flow per share, it doesn't look quite as good. Obviously, they have a lot of stock-based comp. Looks like that's getting under control a bit. It feels like even though Reddit is a very old company, it feels like they're just getting to market maturity. Like they're just trying to get their operating efficiency under control just now. In fact, they're actually early in their journey of becoming a profitable company. They're on a good track, but this company has a lot more to prove to be able to show that it's a great free cash flow generative company. Right now, it's just way too early to tell. Next up, we have Brinker International, which is a weird name, but it's the company that owns Chili's. And I like Chili's. I think it's actually a fun time. Who doesn't like going out to Chili's? Like, I think you have to be a bit of a prude to not enjoy going to Chili's. Sign me up for the triple dipper. That's always my go-to. But I like everything. The chips and salsa there is really good. Chili's has actually done an incredibly good job turning this company around. They used to have a bloated menu. Everything took long to prepare. They implemented a lot of best practices. They have new grills. They simplified their menu. They lowered prices. They really did a great job turning this around. It's been a great turnaround story, and you've seen that in the stock price. Look over the past 5 years. Went from $41 now up to $144. So Chili's implemented all of these changes from a restaurant that seemed like it was struggling, not doing well. Now they're really relevant, doing a great job. When we look at the free cash flow, it's also following. Now, this is again one that you can go way back to 2015. It's not too much above that point, but the company has fundamentally done a lot of changes over just the past couple of years to really grow the free cash flow. On the free cash flow per share basis, it looks a little bit better. They're not really diluting shareholders with this growth. They've reached an all-time high in free cash flow per share. I like it. I think Chili's is headed in a great direction. I'm actually going to put this one up in the B tier category. Might seem a little aggressive, but this company really has had a fantastic turnaround. Free cash flow is growing really, really fast, and it seems like these changes are sticking, like it's going to do well for a while. Next up, we have a company that you may not be familiar with. It's one called Verisk Analytics. And it's one it's a bit out there, right? It's a company that you don't deal with as a customer. The best way to describe this company is they use a lot of analytics and risk measurement tools to help insurance companies properly price different risks for policies that they're implementing. So for example, if an insurance company wants to have like a hurricane policy, Verisk Analytics will help them be able to price that policy to where it's not too expensive, not too cheap, where it's factoring in all the risk. And they have a lot of data to be able to do that. Now, qualitatively, fundamentally, this is an extraordinary company. One that's similar to S&P Global, Equifax. It's deeply embedded. It's part of the process of thousands of different companies. It's high margin software, subscription type revenue, just very, very good. It grew 17% year over year over the past year. We have 15% growth over the past 2 years. When we look at this on a per share basis, it's growing much faster because they're also not dilutive. They're high margin. They funnel this into buybacks. Verisk Analytics belongs in the S tier category. They have S tier free cash flows. Next up, we have CrowdStrike, the cybersecurity company. They went through that whole debacle with the bad update, but things have recovered soundly since then. Everything's moving up and to the right, just like we want to see. We have this nice growth arc for a couple of years, just consistent free cash flow growth. Then it flattens off. Not the biggest problem in the world. It's okay for companies to take a break as they do different investments or they have different things happen with a company for a time. Not every company is going to be perfectly consistent, but this does raise some question marks of what's going on. The big problem for this company is the stock-based comp. It's one of these situations where the stock-based comp is competing with the free cash flow line. You see that? We have the free cash flow growing and it's trying to outcompete their stock-based comp, but they hire so many people. They pay them so much money. They have all these engineers and analytic experts and salespeople. They have marketing people they have to pay. Then on top of that, they have elite engineers that they have to pay. So the people in the company are becoming wealthy. They're getting a lot of value out of the company, but you're the shareholder. We want to know what wealth we're generating. When we look at the net between the two, it doesn't look quite as good. I'm going to put this one down into the D category. CrowdStrike needs to prove that it can really grow the free cash flow without the stock-based comp following up with it. They need to do that for some time. Next up, we have Tesla. Let's go ahead and take a look at how Tesla's doing with their free cash flow. We have a company that was doing really well in 2022, but that was given a lot of tax credits, a lot of incentives, and a lot of stimulus. Their customer base was infused with cash during a time period where interest rates were very low. So you had this combination of money raining down upon people and low interest rates, and Tesla's lineup of vehicles was really fresh. So right now, the free cash flow has been flat for the past 3 or 4 years. Hasn't grown much. Right now, Tesla belongs in the C tier category. Now, finally, we get to Grab. You probably heard about this company, but if you haven't, it's basically like the Uber or DoorDash of Asia. So Indonesia, these type of countries, they use Grab. They're not using Uber and DoorDash as much as they're using Grab. We see a very similar trajectory as Uber. We can kind of draw this straight line going up from 2022 into current day. Now, it's not perfect, but we're getting along that point. When we look at the stock-based comp, there's not much of it, and it's actually going down. I really like what I'm seeing here. If we zoom in a bit further, we go to the free cash flow per share. It doesn't look too much different. Just good growth all around with this company on a free cash flow basis. I think that Grab is further away on its journey than Uber. It still has a bit more to prove. Over time, we could see this one move up to the B tier and the A tier. But right now, I see it as a C. So there you have it. These are some of the most popular companies in the market that I don't have in my portfolio ranked by their free cash flow. Let me know if you disagree or agree on the rankings. That's it for this time. See you in the next one.